Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Welcome to today's Savant Live webinar discussing tax smart philanthropy. Thank you for joining us. My name is Chris Ruedi, and today I have fellow financial advisor from Savant joining me, Justin Smith, who works in our Arizona office. Thanks for joining me today, Justin.
Happy to be here, Chris. Really excited to cover today's topic. So I know that you're all here today because there are causes that you care about and causes that you love to support. But I'm guessing most of the folks here on the webinar today, we've got hundreds of you here. I'm guessing there's not a single one of you that loves taxes. So what we're going to do here today is help you create a bigger impact for the causes you care about while creating a smaller tax bill in the process. And even though we all want you to support those causes that are important to you, we need you to stop writing checks if you really want to maximize your tax benefit. Instead, you need to think bigger and more strategically. Really think about your vision and your goals and how you can make an impact. Once you have that vision, you can then begin to develop a tax smart plan for your philanthropy, which is exactly what we're here to talk about today. But the biggest problem that advisors here at Savant see today is that too many people are still using the charitable giving playbook from 2017, even though the rules have changed. Since the Tax Cuts and Jobs Act in 2017, millions and millions of people are no longer getting a tax benefit for the generous donations they make. And that's because they don't itemize their deductions. But it doesn't have to be that way. You don't have to get zero tax benefit. You just need a plan, and we're going to show you our top 5 favorite strategies for making the most out of your charitable giving. So whether you're donating $100 a year or $100,000 a year, these tax smart strategies are going to reveal techniques that you can use to maximize your impact and minimize your taxes. So these techniques are going to range from the simple to complex, but I really hope that everyone here on the webinar today is going to walk away with some new knowledge and tools that they can utilize. And let's kind of take one step back quickly here. At Savant, when we're looking at somebody's financial situation, we like to break things down into these 10 key areas around this wheel here. Taxes, charitable planning, estate planning are the areas we're going to focus on most today. But if you look closer, you'll see that all of these 10 areas are intertwined, which is why it's critical to have a comprehensive and a holistic strategy. That's how we get to your ideal future, which is at the center here. You can't just look at one element in a vacuum, which again is why you can't just write checks hoping that it's going to achieve your bigger vision and goals. You really do need a holistic strategy. One other thing I'll point out on this wheel here is that your vision and goal is at the top of the wheel for a reason. That's where it all starts. And we like to think about starting there by taking an inventory of what you value, what you have, and what you want to accomplish. From there, we can start to develop, again, this tax smart strategy for your philanthropy, how we can maximize your impact and minimize your taxes. So we're going to get into our top 5 strategies in just a moment, but we'll give you some quick bios first. My name is Justin Smith. I specialize in tax smart retirement planning. I am a certified financial planner professional, a CFA charter holder, and a charter advisor of philanthropy. I'm originally from the Midwest, and I now operate our Phoenix, Arizona office. Special little sidebar to any Arizona residents on the webinar today. The state of Arizona actually provides an incredible opportunity for taxpayers to redirect their state income tax dollars to causes they care about, and it costs you absolutely nothing. In fact, a married couple could send over $5,000 to qualifying causes and get a dollar-for-dollar tax credit. So if you are an Arizona resident, let's be sure to connect offline and talk about that strategy.
I may not be quite as tax focused as Justin, but I certainly do appreciate the value of good strategic decision making. And most important to me is helping to align someone's values with their wealth and providing peace of mind for anyone who's looking for guidance. I'm also a certified financial planner professional and CFA charter holder. My family and I live in Champaign, Illinois, and I work with clients throughout Central Illinois region and beyond. I'm excited to co-host today's webinar with you, Justin. With that out of the way, let's jump right into our top 5 tax smart strategies. As Justin said, we're going to work our way from small and simple techniques up to bigger and more complex strategies. So the first one is bunching deductions. As we mentioned up front, the 2017 Tax Cuts and Jobs Act expanded the standard deduction, which had the effect of significantly reducing the number of households that itemize their deductions. And because charitable contributions are typically reported as itemized deductions, these households were no longer receiving a tax benefit for their donations. With the new rules, you need to be more intentional with your checkbook giving. And if you want to maximize the tax benefits of one of our favorite techniques, to do that, it's called something we call bunching, which we'll cover in just a minute. Well, let's first take a look at itemized deductions with some mortgage interest, real estate taxes, state taxes, and charitable contributions. We can contrast that with the standard deduction. They will get to deduct the larger of the two. Since the standard deduction is much higher, they are effectively getting zero tax benefit for their charitable donation. In years past, they may have received $2,000 or $3,000 in tax savings from that donation of $10,000, but now they're getting nothing. So how can they get more for their buck? What I like to do is bunch together multiple years worth of contributions into a single year's contribution. So instead of $10,000 each year for 5 years, let's say, for example, this couple does $50,000 upfront in 1 year and then nothing for the next 4. That would generate a big upfront deduction, which could be worth as much as $18,500.
Yeah, this is really important, Chris. We have to have this kind of new way to think about our cash giving, given that higher threshold for itemizing. Because if you aren't itemizing to a significant degree, you really need to be thinking about strategies like bunching. And that actually leads to our next point, which is how we can utilize the bunching strategy in coordination with a donor advised fund. So we just talked about how bunching donations together can help put us over that threshold. Again, we use that strategy and increase the tax efficiency even more by, instead of giving cash, donating appreciated assets to something called a donor advised fund instead of writing a check. Because most people on this call probably have some stocks or mutual funds or ETFs or other assets that have seen some growth over the years. Or maybe you have stock from your employer with low cost basis. These are great assets that you can use to fund future charitable giving and help you diversify away from those tax inefficient positions. Another really incredible benefit is that you can retain some control of the dollars once you contribute them to a donor advised fund. You might not want to necessarily disperse all of the funds up front. Again, in Chris's example, if we were giving a $50,000 check, it would all go out in year 1 and you wouldn't do any giving in future years. The donor advised fund solves for that. Lets you, again, make a big contribution up front and then still parse out over time what you actually want to give to charity, because you can spread the actual disbursements over time. It has a lot of the same benefits that having a personal private foundation would have without all the legal complexities and administrative burdens. So you don't need to be Bill and Melinda Gates to make this type of strategy work. So let's kind of recap the benefits and the functionality of a donor advised fund. I first like to think about this as your charitable checking account, if you will. Again, we're going to stop writing checks out of our regular checking account. We want to think about utilizing a charitable checking account, the donor advised fund. The benefits are, first, you can bunch your donations together really effectively here. And the second is that we can, instead of giving cash, donate appreciated assets. And our third big benefit is we can maintain control of when, where, and how much ultimately goes to charity. Now, Fidelity, Vanguard, Charles Schwab, and a number of other organizations have donor advised fund offerings. So this is a very accessible tool. And the way it works is generally that you would open this donor advised fund, you'd make your contribution into it. Again, generally, it's most preferable to use appreciated securities. When those funds land into the donor advised fund, the custodian will sell those assets to diversify and reinvest them. The beauty of it is when Fidelity or Vanguard or Charles Schwab inside your donor advised fund sells that position, there's no tax consequence to you. The gain gets wiped away, but you still get the full value of the contribution you made. And then once that transaction is settled, you can then direct gifts over time out of the donor advised fund into other qualified charities of your choosing. So this is a really impactful strategy to use for if you are in your peak earning years, perhaps you're approaching retirement, because you can fund future giving when you're in the highest tax rates to really maximize the benefit here. This can also be helpful for cash flow purposes with retirement approaching, since you can essentially create that piggy bank or that charitable checkbook for future charitable giving, which is carved out from the rest of your nest egg. And this is such a great option because you get, again, that double tax savings. In the example we mentioned previously, let's imagine somebody who went from $10,000 a year charitable donations to one larger $50,000 donation. You're going to benefit from the itemized deduction that you were previously not getting because you're now bunching those donations, getting over the threshold. And you're getting a second layer of tax savings from donating appreciated securities. So let's imagine you've held a stock for a number of years and it's gone up in value from $25,000 to $50,000. By funding your donor advised fund with that stock, you get to wipe away the $25,000 of embedded gains. So that's a savings of probably $5,000 or more. So just by combining that first strategy of bunching and the second strategy of using a donor advised fund and donating appreciated securities, you can go from zero tax benefit to as much as $23,000 in tax benefits without changing the total amount you're giving. So it is a really strategic leverage point here that we can capitalize on.
Yeah, really well said, Justin. And I think the only thing I would just add to that is, I think sometimes in the complexity or it sounds like complexity of these transactions, one thing that gets overlooked is that once the funds hit the donor advised fund, they don't just have to sit in a cash or a money market position. You mentioned all the number of custodians that help facilitate these donor advised funds. They nearly all have investment options that you can select from to redistribute the assets that you gifted originally. And as you pointed out, since the position that's donated is sold immediately, if you don't plan to spend the entire transferred amount in that 1 year, you can continue to reinvest that in, say, something like a diversified portfolio of stocks or bond funds within the donor advised fund, so you can help achieve that tax-free growth that continue to benefit those charities in future years. So our third strategy, kind of building on what Justin just said, qualified charitable distributions. And, this is one that, may be maybe as impactful for folks on this call. I believe most of you probably have some type of a retirement account, but what you may not always think about is that the government, or Uncle Sam as we like to call him, owns a part of your IRAs and 401ks. And he wants to get paid. The government wants to make sure that they get their due out of the retirement accounts that so many of us hold and have grown throughout the years. So he forces you to take required minimum distributions starting now as early as age 73. And a problem I often come across is that these required minimum distributions can cause people's taxable income to be larger than they would otherwise need to maintain the lifestyle that they want to leave or that they've chosen. They're being forced to take this taxable income that they don't need, but there is a way to cut Uncle Sam out of the equation. With the recent update to the tax code, you can send some or all of these required minimum distributions, or RMDs, directly to a charity and avoid the taxation altogether by making what we call a qualified charitable distribution, or QCD for short. This is perfect for those households that I mentioned that no longer itemize and have at least one member 73 or older, because you don't need to itemize to benefit from a QCD. It's excluded from your income altogether. It's also a better option than taking an itemized deduction for those at the higher end of the income spectrum, because QCDs can reduce the income numbers that are used to calculate Medicare IRMA surcharges and Medicare investment income taxes. So in addition to the income tax savings, maxing out QCD could also save you possibly as much as $4,400 in Medicare premiums or $3,800 in Medicare investment taxes each year if you're on the top end of the investment income spectrum. A few important logistical notes about QCDs. Keep in mind, the QCD must be made directly to a charity. You cannot take a distribution and then redirect it like with a donor advised fund. And it's also not reported on those 1099-R tax forms that you get from the custodians each January. You will receive a document that you need to make sure you coordinate with your tax preparer to reflect that these charitable contributions are given credit properly on your return.
Yeah, Chris, the QCD is a great strategy. It is relatively new. It's probably less than 15 years old, but we've seen that it's getting more and more popular each year. It does take a little bit of additional planning and coordination, but it is well worth it. So I'd also encourage you, if you're planning this, to give yourselves plenty of lead time to execute these transactions. You don't want to wait until the end of December. Give yourself and your custodian some time to process this transaction. So that's going to take us to our fourth strategy, which is charitable trusts. Now, this can seem really complicated at first, but on a high level, it's fairly simple. You can donate assets into a trust in which both you and a charity have beneficial interests. One party is going to receive a series of payments, and the other party is going to receive the remainder. The IRS then actually gives us formulas to value a charity's interest in the trust, and you get a deduction. So these are blessed by the IRS, and they give us the exact formulas to use for these. And the beauty of the charitable trust is that it can be used and customized in a number of different ways. You can be that payment beneficiary. You can elect to receive a series of payments over the course of your life or a specified number of years, and then give the remainder to charity. That's called a charitable remainder trust, or you can flip it around as well. You can pay the charity for a set period of time and then distribute the remainder to yourself or to your family. That's called a charitable lead trust. So again, we don't want to get overly complex here, but let's give you kind of a conceptual example. Let's imagine you have an apple orchard and you also are facing steep income tax and estate tax burdens. Let's say you wanted to enjoy the apples from that orchard for the rest of your life with a reduced impact. You could set up a charitable remainder trust in which, again, you'd receive the fruit for a series of years or for the rest of your life, and then ultimately give away the orchard to charity at the end. That eventual charitable gift at the end of the line actually gets brought forward to today and gives you a big upfront deduction. And there's also going to be tax advantages on the fruit you collect over time. We can also flip it around depending on your situation. Let's say you wanted to keep the orchard long term, but you had no need for the fruit right now. You could set up one of those charitable lead trusts. Again, get a big upfront deduction in exchange for donating the fruit for a series of years, usually 10, 20, maybe 30 years. And there's even a third scenario. Let's say that you wanted to give the orchard to your family, but wanted to avoid estate and gift taxes on the transfer. There's yet another type of charitable lead trust that would help you with that. What you do is donate the fruit to a charity for a number of years with the ownership of the orchard reverting to your heirs at the end of the term. This can be set up so that the value of the charitable deduction upfront fully offsets the value of the transfer, and thus eliminating any estate and gift taxes. So because of the flexibility and the tax benefits, these can be really incredible retirement planning and wealth transfer planning tools. Again, there's going to be that upfront tax deduction. You can also benefit from deferring income that's produced inside the trust. So this is a great way to stretch out and defer the impact of capital gains. If you're selling an asset, if you're moving into retirement, if you're unwinding a large position, or selling an asset like a piece of real estate or a business, this can be a really impactful strategy to integrate there. This can also be, again, as we mentioned, a very effective tool in the wealth transfer toolbox.
Yeah, all this talk of apples, Justin's making me hungry, but I think it's a great example. Hope folks can kind of follow along there, because I think it really tells the story of how these trusts can really be a good tool. And we understand that, maybe not everyone would pursue this particular strategy, but like donor advised funds, like QCDs that we've kind of already touched on, they really can provide a substantial tax benefit both today and in leveraging that estate planning later on. So clearly the complexity that could be involved with these types of transactions, does warrant discussion, coordination with not only your financial planner, but also your estate planning attorney, just to make sure that, the values of what you're really trying to accomplish with this charitable giving are aligned with proper estate execution. And really that brings us to our last topic that we're going to touch on today in any detail, and that's estate planning. And, the primary objective of anyone's estate plan is to ensure that what you have gets to the people, to the organizations that you care about most. It's relatively simple, but if the mechanics aren't designed properly, it could mean more money for the government and less money for your families and those that are most important to you. So imagine that you've likely earmarked some or all of your estate to go to your family, and a number of you probably named some causes that you care about in your will or trust, which is also a great thing to be able to do. But you need to be careful with how you divvy things up, because the different assets have different tax treatments and different rules. So remember that Uncle Sam owns a portion of those retirement accounts that I touched on earlier, and he's going to need to get paid even after you've passed away. So when your heirs inherit retirement accounts, they also inherit the embedded tax liability. Everything else equal, it would be better if your heirs were to inherit non-qualified assets or non-retirement assets, which come with no embedded tax liability. In fact, there's even a provision for the cost basis of these non-retirement or non-qualified assets to be stepped up at death, which means any underlying gains would be wiped away. So let's look at an example. Keep it really simple. You have $1 million retirement account, $1 million of non-retirement assets, and you wanted your heirs to get half and perhaps charitable organizations to get the other half. Where people sometimes run into trouble is that they don't properly coordinate their wills and trusts with their retirement account beneficiary designations. And that can inadvertently send retirement accounts along with that massive tax, embedded tax liability to your heirs. But with the proper design, they could send these retirement accounts to charity and make the embedded tax liability disappear. They would then be able to give those non-qualified assets to their children free of any tax liability. And in instances like this, ensuring the mechanics of the estate plan are tax smart could save your heirs hundreds, possibly hundreds of thousands of dollars, Justin.
Yeah, it's really critical that you're strategically integrating that charitable plan with the estate plan. If you do it correctly, it can work beautifully. But as you just mentioned, a couple simple missteps, a beneficiary designation not filed the right way, could blow up the whole strategy. And as we talked about, our fourth strategy, charitable trusts, are just another element that could potentially be woven into a really well-designed estate plan as well. So very, very powerful tools here to be thinking about. And that, as you mentioned, makes up our top 5 list. Well, we still have some other things to talk about, but those are really the top 5 strategies that we think are most impactful for the people that we're working with, the people we are seeing. I see a lot of questions coming through. Please keep those coming. We are going to get to your questions in a little bit, but we do want to take a quick tangent and talk about adjusting for potential tax law changes. Because we know, if you're not aware, we do have an election coming up this year. We also have the sunset of the Tax Cuts and Jobs Act coming in a couple of years. Both of these things have some significant implications on the tax world and, by virtue of that, the charitable giving world. So we're going to talk about some things that we're watching on the horizon. Again, these are not set in stone, but these are potential tax law changes that have been floated around and that would have a significant impact on how you want to pursue your charitable giving strategy. Any of these things might cause you to defer charitable giving or possibly bring it forward, alter your plan, use different vehicles. So again, this is just something that you need to be constantly paying attention to and constantly monitoring so that you know your charitable plan is best dialed in for the current situation. So the first potential change we want to be looking out for is higher ordinary rates. As we mentioned, the current tax brackets are set to move higher beginning in 2026. That's going to introduce slightly higher tax brackets and also bring the top bracket from 37% to 39.6%. So even without any legislative action, this is set to take place. On its face, you would think that might make charitable contributions more attractive because, again, the value of the deduction would increase. However, there are also proposals floating around that have introduced the idea of capping the value of charitable deductions at 28%. So normally, if let's say you were in the 35% bracket and had a $10,000 charitable deduction, if that would reduce your taxes by $3,500, again, 35% of 10,000. If we had this cap deductions, it might limit the value of the deduction to 28% or $2,800. So one of those things we want to be thinking, if we did see this deduction cap coming in the future, it might be a reason to accelerate some deductions in a high income year.
Very good. I'll take number 2, decreased estate exemptions. And while each state has its own unique estate tax or inheritance tax considerations, the potential of the federal estate tax exemption does apply to all of us individually. However, the estate and gift tax exemption amounts have changed so many times. Most notably, in 2010, we went through a complete calendar year with 0 federal estate. Since then, the limit has gradually increased, where the vast majority of us won't need to worry about having a federally taxable estate. However, the current estate tax exemption is roughly about $13 million per person, and that's set to get cut in half starting in 2026, as Justin pointed out, when the current tax system gets reverted back to its 2017 levels. And just like the income tax rates reverting higher, the estate tax exposure will also be increasing at that point, unless we do see some legislative changes. So for those people who may be exposed to estate tax or concerned about possibly having a federally taxable estate, having that conversation, working that in to your charitable and estate planning is something we feel is really critical.
Yeah. And then we talked about ordinary income tax rates increasing. We talked about estate tax potentially hitting more people. There's also the potential for capital gains rates to change. That's been proposed a number of different times, bringing the maximum capital gain rate to a much higher level. Currently, we have 3 capital gains brackets. We have the 0%, 15%, and 20% is the maximum rate on capital gains. There have been numerous proposals, and I would not be surprised if we see additional proposals in the future to add additional higher capital gains brackets. The most recent proposal was to bring the top capital gains bracket in line with the top ordinary bracket of 39.6. And this would be applied to large gains over $1 million. Now, this wouldn't impact most people in most years, but it would have a major impact if you are, again, selling a large asset like a business or a piece of real estate. For those gains over $1 million, the tax rates would nearly double. So for each additional $1 million of gains, the tax burden could increase by almost $200,000. So this would significantly increase the attractiveness of using some more of these advanced planning strategies like charitable trusts. Going back to our apple orchard example, if you knew 40% or more of the proceeds from the sale of your orchard were going to go to taxes, that makes something like a charitable remainder trust look a lot more attractive. So it's something that is important to be thinking about for all of those that have large, highly appreciated assets on your balance sheet that you might be looking to sell in the future. And those capital gains dovetail with our last point, Chris, which is the elimination of the cost basis step up.
Yeah. And, I think maybe just to kind of reset things here, when we talk about use the term step up in basis or something being stepped up, what do we mean by that? Well, those non-retirement accounts or those non-qualified property, as we were kind of touching on throughout the presentation, when people inherit these non-retirement assets, they can get a huge tax benefit or a tax avoidance when those assets are passed on to the next generation, because it reestablishes the purchase price from the previous owner to the new inheritors now. And so when that asset increases in value, it does create a capital gain, like we talked about, but only now from the value as of the previous owner's passing, not going all the way back to when the original owner purchased it. Under the current law, inheritors do get that step up in basis to market value as of a decedent's date of death. And as you can imagine, where I'm at in central Illinois, or really all over our region, this really impacts families with things like farmland that have really appreciated in value, that can find themselves possibly being caught into some of these estate tax consequences, circumstances as we've been laying out. And, there's been a lot of back and forth as to what the impact of doing away with this provision would be, the limitation or possibly capping the limit on how much things could be stepped up. It's one that I think is going to get a lot of pushback, and now don't know that we see happening anytime soon. But it's certainly something that before it takes place, you'd want to make sure you coordinate with your planner, with your estate tax attorney, that, what are the things that we could do to avoid this if and when we're faced with it. We got really close a year or maybe two ago now, there's time goes by, where we really thought that this was progressing in this fashion. That's rolled back to some degree now, but, always beware that those changes are out there. And just because the law is one way now, don't always take that for granted that it's going to stay that way in the future. So having these regular conversations, we think, is something that could be really beneficial.
Yeah, Chris, that ongoing planning process, I think, is critical. It's the most critical part of this, is that the landscape is going to be constantly shifting. So you need to have a dynamic plan that can adjust with the changes in your life, the changes in the tax code, the changes in the world, so that, again, you can make the most charitable impact while also minimizing your taxes. So we've obviously covered a lot of ground in a very short period of time. And as I mentioned, this is a complex and dynamic planning area, and we have just barely scratched the surface. What we wanted to do today is just make sure you're aware of some of these most commonly leveraged strategies. But if you want to learn more and talk about how we can actually apply these concepts to your personal situation, I invite you to schedule an introductory call to see how we can help. Again, this is highly personalized planning. If you do connect with us, we'll get you paired up with a Savant advisor who can guide you on this planning journey with specific advice on charitable giving and tax planning. And we are going to move on to questions in just a moment. I know we already have dozens there in the Q&A box that we're queued up for, but I know we're not going to have time for them all. So we're going to try to address some of the most frequently occurring issues. But again, your personalized questions, those are best served on a call with an advisor, so we can actually take the time to unpack all the details of your situation. So again, I do encourage you to schedule that introductory 15-minute call. There's a link now in the chat where you can actually click to schedule right now. And I do encourage you to do that so you can get that personalized, customized advice that is really where the value lies with these techniques. All right, so we do have a couple questions we'll get started with. Again, we're not going to get to them all. And you feel free to keep adding them to the Q&A box. Chris, the first thing, I'm seeing a lot of questions about donor advised funds. And there's a lot of specifics. Again, we breezed through it in just a couple minutes, but would you just kind of walk us through from start to finish what that donor advised fund process looks like? Can you kind of give us a rough picture of kind of how that feels, what the steps are?
Yeah, certainly. The first thing I always do is, kind of look at everything on a high level, kind of understand where things stand now, where we're trying to get to, walk through the steps that are involved on how we do this, because we want to make sure that we know exactly what we're doing on each step of the process. But, in your examples, we've been kind of talking about, you've got a highly appreciated stock position. You want to, get a tax benefit from that. You want to benefit a charity. So when we come alongside of you, well, as you mentioned, several other custodians have this. We have the ability to kind of help facilitate with all of them. But what it looks like is making sure that the position as it stands appreciated gets transferred in kind, so that there's no taxable hit to you on paper as the account owner, triggering any kind of taxable capital gain. We get that into a donor advised fund, which you still retain control over. And it's then liquidated and can be kept in cash, kept in a money market. If there's going to be a quick dispersal to a charity of your choice, which Schwab will send out, or we can look into replicating a diversified portfolio, much like maybe you have in your own retirement accounts or your own non-qualified accounts that we're keeping for your benefit. And then as time goes on, if you want to make those annual gifts for a period of time with the balance that's in the donor advised fund, You just instruct the custodian to do that, and then they go ahead and make those disbursements. But the important thing is keep in mind, you get the benefit of the tax deferral up front.
Yeah, that's great, Chris. And then even to take a step further, I've seen a lot of clients and families really put that donor advised fund at the center of their, their family and their family's charitable giving. And it's a great way to bring the next generation into the charitable giving conversation as well, right? Let's think you have that appreciated asset, that big chunk of stock that you donate, and you might fund years, if not decades worth of charitable giving all at once. But the beauty of it is that those assets are going to continue to grow, and you get to direct gifts out every single year. I've seen some really impactful instances where a family, again, will bring in that next generation, and they will all come together and decide, where are we going to make contributions to out of the donor advised fund this year? It can be kind of training wheels for the next generation as well, to get them accustomed to charitable giving, making an impact in the community, just being good stewards of their wealth. So there's softer side benefits to this as well, outside of just those concrete tax benefits. We're seeing a lot of questions on QCDs as well. So I'll go ahead and just kind of, just like Chris did with the donor advised fund, give a little bit more color on the process with that QCD, the qualified charitable distribution. Again, where this makes the most sense is for people who have a significant amount in their pre-tax retirement accounts. This is pretty common to see people who have, successful professionals, people who have worked for a number of years. Their 401k ended up being the largest, or one of the largest assets on their balance sheet. So once they get into retirement, that pre-tax nest egg is pretty substantial, and there is that embedded tax liability. So if they're charitably inclined, once they turn 70 and a half, they're eligible to make QCDs. It used to be that the QCD eligibility was 70 and a half, and RMD, the required minimum start date, was 70 and a half. So the two timelines synced up. Since then, the RMD start date has been pushed out a couple times. So you still have the ability to make QCDs starting at 70 and a half, but it doesn't count against RMDs until, again, 73 or 75, depending on when you're born. For those people who have the majority of their funds in pre-tax retirement accounts, it might make sense for them to do their charitable giving before those RMDs start. Because again, it's still excluded from income. They want to start kind of diffusing that tax liability that's embedded in their IRAs. As far as the limits, an individual can do up to $100,000 a year out of their pre-tax IRA to charity. And that amount is actually indexed for inflation. So it's actually higher than 100,000 now because of the inflation adjustment. And that is per individual. So if both spouses have retirement accounts, the couple can do over $200,000 a year of QCD. So that's a fantastic way to, again, make really impactful charitable giving and cut Uncle Sam out of the equation. We touched on it before, but it's worth noting again, with those QCDs, there is not a special box that gets checked with the IRS tax forms. You do need to have some additional diligence. If you're not careful, you might make that QCD, and if you're not communicating carefully with your tax preparer, they might inadvertently treat that QCD as income. You need to have really clear documentation that says, yes, I gave $10,000 to this charity via a QCD. You want to make sure that's in your tax file when you give it to your accountant, so that when they see your 1099-R, they know to subtract $10,000 out of your income. Again, there's not a box that gets checked. There's not a special form that says subtract $10,000 from my income. You really need to have a coordinated approach. That's something we do. We take the responsibility here at Savant. We want to be very deeply involved with our clients' tax planning and preparation. So that's something we're always watching for. But if you're not careful, it can sneak up on you. And then one last thing is that certain custodians offer a checkbook for IRAs. Now, this isn't always possible, but some people like the ability to still write that check instead of going through the process of filling out a form, requesting a QCD distribution, and having it go to charity. If your custodian allows, you can sometimes set up a checkbook so you can actually write a check out of your IRA and give that to charity. Now, you need to make sure you're managing the cash appropriately. You're doing all that documentation on the front end, or on the back end, sorry, with tax preparation, but it can be a valuable tool. Chris, what other questions are we seeing? What else should we cover?
Yeah, no, I saw a lot of the QCD things as well. I don't know if just based on the complexity of the lead trust and the remainder trust, if you can just maybe touch on, is there a certain amount? Can someone leave do they leave a percentage of the remainder to either the charity or their heirs that they go that route, or can they specify specific dollar values?
It's generally on percentages, and if we kind of zoom back out on those trusts, those are the most complex tool in this toolbox that we've covered today. Generally speaking, because of that complexity level, because again, you're going to need to bring in specialized attorneys, and your accountant's going to need to be in the mix on this. Obviously, you want an advisor kind of overseeing the big picture. Generally speaking, until we're dealing with seven figures in these charitable trusts, it's probably not large enough to make up for all that overhead. But if you are at that level, then it can make sense. You asked about kind of some of the percentages and how those might work. On the charitable remainder trusts, if you are, again, that income beneficiary, you get to customize in the trust what percentage payout you want. It has to be a minimum of 5%, but it can be higher as long as the IRS calculations work. And that's going to be dependent on interest rates, your age, et cetera. So that's a bit more complex, but 5% is something we see a lot. So let's say somebody puts $1 million of highly appreciated assets into a charitable trust. They get that 5% payout for the rest of their life, or $50,000 for the rest of their life. And they're also going to get an upfront deduction because the IRS is going to look at that $1 million gift and say, we think based on our calculations that eventual charitable gift that's going to go to them at the end of your life is worth $300,000, and you get that deduction today. So that again is why it can be so impactful, because you can pair up this charitable trust with, say, a business sale, a real estate sale, farm sale, whatever it might be, to really mitigate and tamp down the tax impact. In terms of what percentage of your total net worth or total balance sheet might want to go in there, it probably should be, it's really, really situationally dependent, but it's probably well less than 50%, if not less than 25%. Because again, this is just one component of the overall plan. And then one other thing worth touching on, again, as I mentioned, the charitable trusts are a pretty high level of complexity, a high bar to make it make sense. But the beautiful thing is that there's another tool that is getting a little bit more traction called a charitable gift annuity that kind of functions like a simplified, streamlined version of that charitable remainder trust. So the charitable gift annuity, you have to work with a charitable organization that offers these, but there are lots. Many of the larger national charitable organizations will offer these charitable gift annuities. You can, again, donate cash, donate appreciated stock, potentially even donate land, real estate, business interest. And that charity is going to take on the burden of taking the asset, receiving the asset, selling the asset, and then paying you an income stream for your life. You will get some form of deduction up front, and there might be tax advantages on that stream of payments over time. So let's say you wanted that charitable remainder trust in concept sounded attractive, but maybe the scale was just not there for you. The charitable gift annuity can work at a much smaller level. We see organizations that will even do charitable gift annuities with $50,000, sometimes even less. So you can get that same lifetime retirement income stream with a charitable tax impact or benefit upfront with a charitable gift annuity. So we didn't have time to touch on that today, but that is becoming more and more prevalent, more and more attractive tool in the toolbox we want to consider as well. Okay, I think that is about all the time we have for questions today. If your specific question wasn't answered, there's going to be a survey that pops up at the end. You can enter it there. And again, the best avenue to get your question answered and to get specific, actionable, personalized advice is to talk to a Savant advisor. So again, in the follow-up email and in the chat right now, there's that link to schedule a 15-minute complimentary consultation. We do welcome you to schedule there, and we look forward to talking to you soon. Thanks all.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.